Is Wall Street cool anymore? Well, for a while there, Wall Street kind of lost its mystique. The 1980s had Gordon Gekko. I know that's what attracted me to Wall Street. The 1990s had the Salomon Brothers legends and the Michael Lewis Liar's Poker that brought them to life. The 2000s had traders making 8 figures before 35. And then after 2008, suddenly everybody wanted to work in tech. Coding became cooler than capital markets. Founders became cooler than financiers. The hoodie beat the Brioni suit. Perish that thought, but it did. And here's one thing nobody says out loud anymore. Wall Street never stopped mattering. In fact, in many ways, Wall Street today is more powerful than it's ever been. But the difference is that the money got quieter, smarter, and far more specialized. And if you're sitting there wondering, is Wall Street still cool? Well, the answer, of course, is yes. But how cool depends entirely on where you sit inside the machine. Because Wall Street is not one job, it's a civilization. And inside that civilization is a brutal prestige hierarchy where your compensation, lifestyle, exit opportunities, and social status all depend on what division you're in. So today, we're examining every major Wall Street career path, what they actually do, what they get paid, which jobs are respected, which jobs secretly are not, the best paths out of undergrad, the best paths out of MBA programs, and which seats still carry real power in 2026. So first, the 3 layers of Wall Street. Every major bank splits into 3 categories. The front office, which is the revenue generators. These are the people directly making money, investment bankers, traders, salespeople, private equity professionals, hedge fund analysts, equity capital market and debt capital markets teams, syndicate desks, and the like. These jobs have high prestige, the highest pay, and the worst hours. Second of the 3 layers is the middle office. Risk and infrastructure. Examples: risk management, treasury, quant analytics, product control, and compliance. These people keep the casino from exploding, but prestige, not as much. Compensation, still good. Hours, way better. And then you have the third of the 3 layers in Wall Street, the back office, operations. Examples: settlements, reconciliation, internal audit, HR, support functions, IT, necessary jobs. But internally, there's like low prestige on Wall Street. But yes, Wall Street absolutely judges prestige internally. So a Goldman Sachs M&A analyst and a Goldman Sachs settlement analyst are not viewed the same way inside finance, not even remotely. The core Wall Street prestige rankings get a little bit controversial because Wall Street absolutely has a caste system. And here's roughly how insiders rank the major paths. So tier 1, or the apex predators, these are the jobs that make people whisper. We start, of course, with hedge funds. These are the top G's of finance. They are directly betting on markets. There's no hiding, no excuses, no PowerPoints. You are judged solely by your P&L, your typical path. First, you're an investment banking analyst. Then you make your way into private equity, or at least research. Then you become a hedge fund analyst, ultimately work your way up to a portfolio manager. And the pay? A junior analyst, once inside a hedge fund, will start at about $250 and usually top out at around $600,000. A senior analyst will make $1 million plus. A portfolio manager will make somewhere in the $5 to $50 million neighborhood, and a top-tier portfolio manager will just absurd money. And the prestige, of course, is maximum. But here's the catch: most people wash out because, unlike banking, hedge funds are pure meritocracy. If you lose money, you disappear. So what's a rung below hedge funds? Private equity. Private equity became new Wall Street aristocracy after 2008. And why is that? Because instead of pitching deals, like what I do on the sell side, they owned the deals. Blackstone, KKR, Apollo are top examples. These firms buy companies using leverage, they improve them, and they sell them later. So an associate at a fund like this will make something in the $300,000 to $600,000 neighborhood. A VP will make somewhere between $700,000 and $2 million. And a partner make somewhere between $5 million and $100 million plus. So the prestige, of course, is extremely high. The hours are still brutal, But compared to banking, well, you have more control over your life, which brings us to the third rung on the ladder, investment banking, the classic path. That's where I am. This is where it's still the foundation of Wall Street prestige. It's when normal people imagine Wall Street, they usually mean investment banking. And inside investment banking itself, there are many different kingdoms. So we'll start with M&A advisory. That's what I do, but I'm in the middle market, so I can't pretend that I'm at the very top that I'll talk about here. But the prestige in M&A, especially at a bulge bracket, is king. So mergers and acquisitions is still viewed as the most prestigious banking group. Why? It's the highest complexity, the most CEO interaction, the most modeling, the biggest strategic importance. This is where billion-dollar deals happen, and the typical pay for an analyst is between $200,000 and $300,000. An associate makes between $350,000 and $600,000. A VP can make between $700,000 and $1.5 million. An MD will make anywhere from $2 to $20 million plus. The hours are brutal, absolutely horrific. 90-hour work weeks are real and sometimes considered light. But M&A remains the best launching pad into private equity, hedge fund, corporate strategy, and activist investing. So if you're elite out of undergrad, this is still one of the top starting points. Next group under M&A, leveraged finance. LevFin is where debt meets private equity. These teams include LBO financing, high yield bonds, leveraged loans, and they work heavily with PE firms. So the prestige is very high, especially because LevFin bankers understand how deals actually get financed. And so the opportunities are excellent into private credit, PE, direct lending, and credit hedge funds. The compensation is similar to M&A. The lifestyle is slightly better in some firms, but still awful. And so the next rung down the investment banking hierarchy would be equity capital markets. This is where things get interesting. ECM sits between investment banking, markets, and institutional investors. These teams help companies IPO, raise follow-on equity, price stock offerings, execute block trades, and structure convertibles. Equity capital markets bankers are less spreadsheet monk and more market oriented. You need market instincts, investor psychology, and timing awareness. The pay is not as good, but still excellent. Analysts will make somewhere between $170 and $275. Keep in mind, these are kids a couple years out of college. All the way up at the top end, the MDs will make somewhere between $1 and $8 million, and they've got everybody in between. The prestige is strong internally, but usually viewed slightly below M&A. And why? Because equity capital markets is often seen as more execution-oriented than deeply strategic, but the lifestyle is significantly better. And in a hot IPO market, it flips. Equity capital markets becomes one of the most powerful seats on Wall Street, especially during the bubbles. 2000, 2001, SPAC mania. Suddenly, equity capital markets bankers looked like deities. And their the fees they generated were amazing. So the exit opportunities would be things like hedge funds, equity investing, investor relations, and corporate finance. Then we have kind of their step cousin, debt capital markets. And so they're kind of the opposite side of the balance sheet. These teams help companies issue investment-grade debt, corporate bonds, sovereign debt, and structured notes. DCM, or debt capital markets, is more market-oriented, more macro-oriented. You think about interest rates, credit spreads, Fed policy, yield curves. Pretty typical to equity capital markets, but maybe not quite as good. The analysts make somewhere between 160 and 250. Again, not bad for a kid who's somewhere between 1 and 3 years out of college. A senior banker will make somewhere between 1 and 5 million. The prestige is moderate to low high, depending on the bank where you are. Wall Street respects debt capital markets because debt markets are enormous, but culturally, debt capital markets is viewed as smarter hours, low prestige. And honestly, many debt capital market bankers are perfectly fine with that trade. They get lifestyle that's way better than M&A for pay that's not much worse. So the syndicate desk, this is the next rung. This is kind of the hidden power center. This is one outsiders almost never understand. The syndicate desk is one of the most fascinating seats on Wall Street. These people sit between bankers, sales and trading, and institutional investors. Their job is to actually distribute securities into the market. In equity capital markets, they allocate IPO shares. In debt capital markets, they price and distribute bonds. This means syndicate professionals know who's buying, who's selling, real demand, real market appetite. They often have better feel for markets than bankers themselves. The prestige, it's kind of a quiet prestige. It's internally respected. Externally, nobody knows what they are. The pay, it's still pretty decent. It's comparable. Junior is going to make somewhere between 175 and 300. Senior syndicate head will make somewhere between 1 and 10 million. The lifestyle is way better than M&A. And the people who are good at syndicate are very difficult to replace because markets are part math, part psychology, and part politics. And then we have sales and trading. This used to be the Wall Street dream job. Fast talking, big risk, huge bonuses. But today, it's more electronic, more quantitative, less screaming. But top traders still make unbelievable money. And so their roles include equities, fixed income, foreign exchange or FX, commodities, derivatives. Now, salespeople managing relationships with hedge funds, pension funds, and sovereign wealth funds. Traders manage risk and positioning, and the pay is similar. Juniors will make somewhere between 150 and 300. A senior trader will make millions annually. The prestige is still high, but way less dominant than the 80s and 90s. Lifestyle is way better than banking, but there's much more stress during market hours. And then we have equity research. These are analysts publishing views on stocks. They build models, earnings forecasts, and industry reports. They used to be massively prestigious. But regulation and shrinking commissions hurt the business. But elite analysts still wield influence. A junior is going to make somewhere between 140 and 250. A senior star analyst will make in the millions, and there's a wide range to what research positions get paid. But they're great paths into hedge funds, long-only investing, and portfolio management. So then below them, we've got asset management. We call these guys quiet rich. This is where adult money lives. This would be like Fidelity, Capital Group, PIMCO. It's way less flashy. It's less ego-driven, but often much better lifestyle, way longer career, very low burnout. You manage money slowly and intelligently. Not every finance career needs cocaine energy chaos. Below that, you've got quant trading. And this is kind of the new elite. Now, this is the future. These are firms like Jane Street, Citadel Securities, and Hudson River Trading. These firms increasingly recruit math Olympians, physicists, and coders. A top quant trader today may outrank traditional bankers socially inside elite finance circles. Their pay is absolutely insane. New grads can make $300,000 to $500,000 immediately, like right out of college. And the catch, the competition is horrifying. So which jobs are actually cool? Well, here's the truth. Wall Street coolness today comes from 5 things. Number 1, compensation. Money still matters, probably most. Number 2 is selectivity. How hard is it to get in? 3 would be exit opportunities. Can this role lead elsewhere? 4th is proximity to power. Are you advising CEOs, deploying billions, moving markets? And 5th would be scarcity. How easily can you be replaced? The best paths out of undergrad. So if you're just graduating college today, tier 1, I'd say would be M&A, leverage finance, elite boutique banking, quant trading, sales and trading. These maximize your future options, and they pay really well. The best lifestyle to money ratio is going to be either equity or debt capital markets, the syndicate desk, and asset management. Still elite, but less soul destruction. The best paths out of MBA programs. MBA recruiting is different. Post-MBA hiring heavily targets associate investment bankers, consulting, corporate strategy, asset management, and what are the top MBA schools? The ones you'd think of. Harvard, Wharton, Columbia, UC Booth, Stanford, places like that. Post-MBA investment banking associates usually start somewhere in the 350 neighborhood and move up to 500,000 pretty quickly. And many later transition into PE, Corp Dev, and CFO tracks. The big secret nobody says is Wall Street is no longer one culture. It's fractured into tribes. The old school relationship banker, the macro trader, The quant, the PE operator, the activist investor, the syndicate strategist, and increasingly, the smartest people in finance are moving towards private credit, quantitative trading, infrastructure investing, energy transition capital, alternative assets, and not necessarily traditional banking. So, is Wall Street still cool? Yes, but not because of movies, at least anymore. Wall Street is cool because capital still controls the world, markets still determine power, and the people allocating capital still shape civilization itself. The difference now is the coolest people on Wall Street often look nothing like the stereotypes. The modern kings of finance might be a quant in a hoodie, a syndicate head pricing billion-dollar deals at 6 a.m., a PE partner quietly buying entire industries and rolling them up, or a hedge fund PM making decisions that move nations. Wall Street never died. It just got smarter, more fragmented, and far more difficult to understand from the outside. And now you know the rest of the Wall Street story. Build that stack. iBankerU. Good day.